Hello, everybody. Welcome to Coach's Playbook. Sorry for delay. This is, of course, the show where four old farts try and figure out how to work Zoom with Dan not here. But we're here now, as far as I could tell. And today, the topic is we're going to talk a little bit about the VIX has dropped below 20 over the last few weeks. This was something that was what life was for the last couple of years before a certain pandemic befell us. But it's been so quick the last year. We thought today we'd talk a little bit about strategies for trading slower markets when things aren't whipping around all over the place. But before we do that, Mick is going to tell us about a trader who made some money whipping all sorts of money all over the place. What you got for us, Mick?
Yeah, speaking of the VIX, we big shout out to Lisa Chen. She put up $1,900 today trading the S&P. So congrats, happy for you.
Yeah,
wow, not a bad day.
Says a lot, especially as slow as it is.
Mm-hmm.
Well, that's good. If you can grind out those 1,900 days, that's those will add up quick, even if the market's slow. So
Yeah.
Why don't we start by talking a little bit about, I think we've had shows where we've explained the VIX before, but in case anyone doesn't know, it's a measure of volatility that's based on options. On option premium size, basically. Does anyone have anything they want to add about that before we start talking about what sort of signals a slow market in it and what this will change in your strategies as you approach the futures market? Maybe Hogue.
Yeah, sure. When you think about last year in March, when we had VIX trading up around 80, the kind of volatility and the size of ranges we were having, some people like it, some people don't. What it does is it increases your risk and also increases the potential profit targets in the trades that you're going to have. When we get down below, let's say 25, we're right around 20 today. Ranges are a lot smaller, opportunities are smaller. It's really a kind of an adjustment, I think, to trade successfully in low volatility days and low volatility periods. When the VIX is this low, you really want to think about adding a couple of contracts to your trading, because it's probably going to be a lower risk environment. And it's also going to be an environment where you're really going to try and focus on keeping your profit targets reasonable. The big profit targets of the volatile times just aren't available right now. I mean, right now, as we speak, I think we've got an 11-point range in the S&Ps. So smallest range we've had in a while. And it's likely to change, but just keeping in mind that the smaller risk, maybe add a couple of contracts or one contract. If you're trading one, add another one. I mean, it doubles your risk. And then keep your profit targets reasonable. You're, in range bound, you may actually be able to trade a little bit more for kind of smaller profits, therefore smaller risk. Add one to your strategy, and it's really about keeping your expectations reasonable when you're trading in less volatile markets.
Well, this is truly monumental. We got Hogue recommending that everyone out there go and size up.
Yeah, right.
Yeah.
I feel like 90% of trading advice boils down to, if you're not feeling it, size down, get consistent. But in these low volatility environments, yeah, you got to size up responsibly, so to speak. I always had trouble. I'll move on to JD next. I always had trouble in slow markets. I was not part of the reason that I left the prop industry was because of that era where things were so slow. I did not have necessarily the discipline to go in there and grind it out with fairly big size every day. And I wish that I had kind of, instead of adopting sort of a fatalistic attitude of well, F this, nothing's good, bad beats, blaming the misses. I wish that I had spent more time sort of embracing what you have and seeing what you can do with it. So JD, I know you have some experience in the slower markets too, so maybe you could elaborate.
For sure. Well, first, aside from just making good trades, I really think our number one job as traders is to preserve capital. And we've talked about this before. So if you really do prefer those wider swings, the higher volatility markets, or I guess if history has told you that you don't perform well during times of low volatility, there's nothing wrong with just sitting out and waiting for things to pick up again. A lot can go wrong when you're not used to range trading. I mean, on paper, it looks like it should be so simple. You keep buying the bottom and selling the top, right? That's when you look at that chart, it looks like it should be so easy. But it really only takes that one, I guess, perceived missed opportunity. And before you know it, FOMO's setting in and you start buying the middle of the range and you're getting stopped out where you should have gotten in. You're just getting chopped up. Or even worse, you start thinking about or anticipating breakouts coming. So you start adding size when you really shouldn't be, just to get stopped out at the other side of the range,
Yeah.
Personally, I like to be in the market. I've been doing this for a long time. I've traded in probably every type of market environment there is. And it's hard, but it takes discipline. But the first thing I wanted to do, just like Hoke said, maybe increasing size. I won't decrease my size right away until I know that it's time to decrease size. And I seriously just play the range until the market tells me that it's time to stop playing the range.
Yeah.
You don't get angry if you miss a trade. The odds are pretty good that it's going to come back again and you're going to get another shot. So my best advice would be when things are slow and it's moving sideways, don't anticipate moves, just participate in the moves that you see happening.
Mhm.
Counterintuitively, I always noticed that in the slow markets is when, at least for me and the type of trading I was doing, was when the worst blowouts would occur, because you were fading, cannonballing these, in the case, bond spreads that I was doing, where they're staying in, so you're just adding, go back. But then when they actually do, the market pukes or whatever, it's way worse because everyone's got a ton of size on it. It becomes a scramble for the exit. So versus in the fast markets, I mean, people could make bad decisions and get blown out. Of course, you can do that in the fast market, but people were more not scared, but cognizant of that. They knew not to trade all that size. They knew things were moving. Mick, you were in the grains, right?
Mhm.
Is it ever slow there? I know basically nothing about the grains futures.
Well, yes, there's certainly slow times, slower moving products. So when I think grains, wheat, corn, soybeans, I mean, corn's priced quite a bit lower than wheat and soybeans. So corn is one of those products where, because I mean, any product can move quickly, and that those products have their days. Corn was traditionally looked at as a little bit of a slower moving product than those two. So you might, like John said, if it's slow, you could trade a little bit bigger. I think there were people that, put on larger corn positions because of, the slower movement or potential slower movement in that market. When it comes to, trading slower markets, I mean, market environment's always changing. We go from volatile to low volatility. That's always going to be happening. There's always these cycles. I would, as a trader, I would say, adjust your expectations. If we're not having large ranges, you might not catch that 20-point move in the S&Ps. Obviously, if there's narrower ranges. I'm happy that John started us off by talking about the position sizing and maybe trading a little bit bigger, because we so often preach, trade smaller. Trading smaller than you can always give yourself a lot of extra flexibility there. You don't get squeezed out of trades because you need to play things too tight. And also when your trading strategy is not working in the current environment, you scale back, you take your foot off the pedal. So this is kind of, there's like two sides to this story. I mean, you could trade a little bit larger in order to capture, larger profits on smaller moves. But also, I agree with that, fully. But also, if narrow ranges and low volatility is not good for the strategy that you're implementing, then it's better just to sit on the sidelines. Jack, I liked what you said about giving people insight into what might happen with the blowouts on larger firms. Just trading too large. It does only take one day for something to get snapped out of whack, and if you're too loaded up, it's just a reality.
two quick points is you got to watch out for the herd mentality there, because I assume a lot of anyone out here who's watching this or in Top Step, I know a lot of you are in various Discord communities or you're trading with other people. What I always notice is when the volatility got low, there would always someone that pushed their size to something that was unthinkable before. You know, everyone, you have your community, you have what you think size is, and then somebody would start pushing it in a slow environment, and that person would make a ton of money. Then everyone else would say, well, if so and so is doing it, I'm going to push a little more too. And it feeds off each other until the size becomes kind of unwieldy. And if there's one thing that's true about volatility, we're using the VIX as a proxy for it because it's easy and everyone looks at it. It explodes and then decays usually slowly. So back before the COVID stuff, I think the VIX was down around 13. It was below 15 for a while. It's a very slow market where there's not a lot moving. But then when it comes, the VIX always explodes very rapidly because it's usually some sort of exogenous shock, and then decays slowly because we've been seeing it do that for a whole year. You're unlikely to see the volatility will always, by definition, catch you when you're not expecting it. Because if you expected it, it'd be more volatile, right? So you always in the back of your mind have to be careful to manage your risk, and especially don't get caught being complacent in a market that's slow where you have more size and you're just kind of, this is the new normal, because something always going to bite you.
One other thing I want to add about slow markets and us with the current market environment, I mean, with equities grinding higher and making new highs, I talk to a lot of traders that have difficult times, during this, slow grind up. And, I understand it. It's easy to say in hindsight, like, oh, geez, I could have just, bought this stuff every day and made a bunch of money, but it's really hard. Yes, you want to follow the trend. But do you want to be buying something that's already been marked up 6 days in a row? That's a question. Alternatively, it's like you don't want to short these things either, because you're really, you're fighting against the trend, and the odds really, as far as continuation goes, are not on your side as far as wanting to go short and then finding the right time, price to do so. It's very, very tricky. But what I see a lot of traders getting caught up doing are, because it's slow, because there's not a lot of opportunity, with narrower ranges, they're sitting there waiting for a big sell-off, because, we know that markets can fall faster than they rise. And there's, unfortunately, a lot of people, I think it's only natural to try and think that way, looking for a big move down. But I see a lot of people when, we're slowly grinding up, instead of, buying it every morning and selling out at the end of the day, there's a lot of people that are going short thinking, hey, if I'm just short when this happens, I'm going to make a bunch of money. And they get, slowly cut to pieces trying to do so.
Yeah, those lottery tickets, they're sexy.
Oh, yeah. Yes. 30 years I've been watching short time frame day traders working the short side of the S&Ps because they all want to catch that big next move to the downside. And the market just grinds them up and grinds them up and grinds them up. It's very difficult to time an increase in volatility or a big downside move in the S&Ps or the NASDAQ. And if you are able to time it right, it's probably as about luck as anything else. Going back to the position sizing, if you're used to, let's say, just for example, risking $400 for a one lot in the S&Ps during a more volatile period, during a less volatile period, maybe your stop isn't going to be as far away. Your technical, basically, point of invalidation stop isn't going to be as far away. So maybe in certain trades in range bound or slower periods of time, you're only going to need to risk 200 to get to your point of invalidation. That allows you to still risk that 400 using two contracts. And if the market goes your way, you're going to take some bigger profits out. It's just the way kind of position sizing works. It's based on the risk you have to take to get into the trade.
Yeah.
It's there was one other thing I had to say, but I lost it here. So
It's all right. We'll wait for you to remember that. Hope's been our audio visual wizard today, just kind of figuring stuff out for us. But yeah,
Yeah,
you
right.
should always scale your targets and stops to volatility, and it often scales with size too. You trade bigger size with tighter stops, usually lower targets, and you trade smaller size with wider targets when things are moving all over the place.
Mhm.
I want to mention one other thing, and I think this ability to adapt in slower, lower volatility or adapt in higher volatility. I think it's one of the greatest things about these markets. Ever changing. You're always going to be challenged. You're always going to be needing to find ways to make adjustments to either preserve your capital or capitalize on opportunities.
Yeah, 1+1 rarely equals 2 in this environment, does it?
No, sir.
Now I remember what I was going to say. Jack, you were talking about, when you're in a range bound trade and you're used to trading a little bit bigger, sometimes you can get the rug pulled out from under you when that market state breaks. And sometimes it's a news event. We can't foresee these things to happen. So of course you're using stops, and you really want to be able to keep a hypothesis or some sort of expectation that says, okay, this is different now. I'm going to have to adjust the way I trade it and go back to trading smaller opportunities as the volatility increases. I thought that was a really good point, Jack.
Yeah, and I think what you mentioned there is just true in all market environments. You have to be objective about how you're doing, how your strategy is working, and then size up or size down accordingly.
Mm-hmm.
Doesn't matter if the VIX is
Well,
100 or the VIX is 10 or wherever we're headed to now.
Right.
Yeah.
We've got a few comments here. Level 2 is
Sure.
asking if that's the dancing bear or if that's Santa Claus.
Hey-o.
Hey, you're working on it.
Good one, buddy.
JD cut the beard too. At one point, you had a strong COVID beard going where you kind of looked like a professional wrestler or a logger. It was quite something.
I'm due for another trim for sure. We'll clean it up for next week.
And he's on level 2 is also agreeing with us. Mr. Shine is also saying hello. Mr. Shine's mystery channel. Hello.
Hello, Mr.
Level 2
Channel.
is also saying smaller range allows tighter stops and size up with good management. Absolutely. Level 2, 2015 was 15 full range on good days.
Yeah.
Right. So I think he's talking about the S&Ps. Mini was comfortable back then. Now, in his opinion, retail guys should be trading micros. It allows for more mobility and execution and management. Murph saying hello. I keep forgetting about Coach's Corner, and I never get notification when it's happening. I get the notification for Market Forecast to recap. Weird. Well, we'll see if we can't figure that out. I had to run the thing today, so we're lucky we're even here.
Well, we could give a couple updates on that. Number one, that's a prescient comment by Level 2 talking about 2015, because as luck would have it, October of 2015 is when I left the trading industry. So those two are tightly correlated. As far as the Coach's Playbook stuff, we got some exciting stuff in that we finally hired a video producer at Top Step. And I think, most of us are vaccinated or near there. So pretty soon we're thinking, at least some of us, at least Dan and I, will probably be in studio for this on Tuesdays. So we'll see how that goes. And maybe we'll have a snazzier production value. We'll have, what else can we put in there? How does HBO make good stuff? Probably no nudity. I don't think Patak would like that.
We have Lance Gold saying that seriously helpful chat today, as the market is, as far as I can tell, still in an 11-point range.
Yeah. Or you could all start, flinging shares of GameStop. I mean, there's always volatility somewhere, but be responsible. So I was thinking since Dan's not here, I don't know if anyone else had a quote or something like that. I was thinking we could either brainstorm, what's a Dan Hodgman quote we could use?
Here, I've got one for you.
Okay.
If you can't manage risk, making more money isn't going to help.
That's 100% true.
Perfect.
Yeah, you can always, no matter how much money you can have, you can always.
I have no idea where that quote came from, so I'm gonna attribute it to my dad.
All right, we'll give it to Hoag's dad. Well, everyone, that's all for this week. We got the release of Coach T this week, right, JD?
coming up Thursday.
That'll be
eye
exciting.
out.
So yeah, so JD's been writing some blogs on it. It's our attempt at making a digital version of Hogue and the Performance Coaches. Let us know, like, if you get a chance to use it. We're always appreciative of feedback, but we're hoping it's something that can incorporate some sort of risk management metrics into your trading in the combine or elsewhere. And yeah, that's all we got for now. So
Guess maybe I should get my resume brushed up, huh?
oh yeah, we're gonna we're gonna outsource Hogue. We replaced Hogue with 5 lines of JavaScript. Oh man, it should be exciting.
Thanks, guys. Like they said, it was a helpful chat today. And should I wrap it up?
Yeah, let's do it.
All right. Well, manage your risk. Be reasonable with your expectations as far as profit targets are today. Get out there and profit, trade well today. We'll see you next time.
Or right now until Hogue finds the button.
Nice job on the controls today, John.
Well, we're still live.
I'm just going to end the meeting.
You know, broadcast your lunch to everybody now.